Hello, everyone, and thank you for joining us today. I'm Tara McBride, Chief Marketing Officer at Prime Capital Financial, and I know many of you are feeling the weight of recent market volatility. We get it. These fluctuations can be unsettling, but today we're here to provide clarity, context, and most importantly, a strategy to help you stay the course. Before we get started, I'd like to share that we have a free resource available for you to download. You can scan the QR code on the screen or click the link in our show notes. It's a great one-sheeter that will give you even more background on market volatility and how to plan for it. So make sure you grab that. I'm joined today by not two, but three of our top investment minds here at Prime Capital Financial. Clayton Allison, Portfolio Manager, Scott Duba, Chief Investment Officer and President of Wealth Management, and Will McGough, our Deputy Chief Investment Officer. We're unpacking what's been driving market swings, why volatility is a normal part of investing, and how to stay focused on long-term success. So let's jump in. Scott, Will, Clayton, you manage more than $30 billion in assets and over 15,000 households. What is going on? What's driving this market right now?
Sure, I'll take the first crack at it. Look, I think context is important. We've had a very healthy market for really 2 years. We had back-to-back years over 20% returns in the major indices. And now, for the first time in a while, we're experiencing some volatility. And it feels like more because it's been a while. And to state the obvious, the new administration has a lot of grand plans, some of which are potentially impactful to the economy. And right now, the market is really trying to digest a lot of moving parts and figure out, what the outlook really is for the economy and the markets themselves.
Yeah, Scott, I love how you said it feels like more because this one's gone south quick. Typically, when we see 10% pullbacks, they churn out over a couple of weeks, and we're maybe like 10 or 12 days in on this one. So I do understand and empathize with the speed of this pullback, and it is simply a reaction to Washington, D.C.'s policies, reverberating through the world. We have tariffs, we have defense spending, geopolitical concerns. But to me, the most interesting part is earnings growth. The main driver of fundamental value is still there. So this is all a shift in sentiment that we've talked about as a team. And so like, kind of curious if you have any insights from a bottom-up perspective.
No, I think you guys all hit it both right on the head. You said, well, earnings growth is still there, but like we've seen, valuations have kind of gotten stretched over the last 2 years as markets have continued to rally higher and higher and higher. Now you've got a kind of a bit of a divided nation right now with the administration that's in there and all the various trade policies that are coming forth. So you've got some people that might be looking at the market and saying, I've made a lot of money over the last 2 years. Might be time to take some profit and some risk off the table as to how these policy changes are going to be enacted and how some stability can be brought forth. But right now, we're feeling a lot of uncertainty, and if there's one thing that the markets hate, it's uncertainty.
So I know this question is a little loaded because it kind of changes, I feel like minute to minute and day to day for sure. But how much of the equity markets decline?
Quite substantially so far. Will might be better off on the pure data pulling as to peak to trough at the moment, but so far year to date, the S&P 500, it's down around 5%. You've got the NASDAQ, which is very tech heavy, down close to 10. Small caps are not escaping that either. They're down about 9. Now the old-fashioned Dow Jones, it's down a little bit like 2%, but there's not really a place to hide right now. European, international funds have done a little bit better. That could be a byproduct of obviously all the evolving trade policy like we've mentioned in the current administration. But right now, there's not a whole lot of safe havens out there if you're an equity investor currently.
Yeah, and Clayton, you mentioned year-to-date returns. If we look at it from peak to trough for the S&P price index, it almost hit a 10% drawdown on the dot. I think it was like 10.04%. And so if we look at historical averages for the average drawdown of the S&P, it's about 13-14%. So we can expect volatility, and we've been cautioning our advisors and clients that things are going to change with Trump coming on board, and to maybe expect a little bit more volatility going forward than what we've seen the last 2 years with really solid 20% back-to-back up years. And so volatility is the toll that we pay as investors for long-term compounded returns. And what we're seeing right now is just a routine correction, and we can probably banter about whether this turns into something bigger or whether it's a dip to buy. But Scott, kind of curious your comments here as well.
Yeah, I think what's somewhat been underplayed over the past 2 years with the equity market's strength is the importance of diversification. The fixed income markets are obviously holding up better year to date, and that's just a theme that people appreciate more in times of volatility. is, we've seen a lot of volatility in the U.S. Treasury market over the recent past, but year to date, the yield on the 10-year is actually down, which is good for bond holdings and adding a little bit of a ballast to our diversified portfolios.
So, is there anything unique about this volatility that we're seeing?
I would say every bout of volatility has its individual causal drivers, but they all kind of manifest into just a shift in sentiment. And I'd say what's unique is there's a lot of cross currents right now. It's not any one individual thing. I think the uncertainty around the macro as it pertains to tariffs and what impact that might have. You combine that with a Fed that might be a little bit less eager to cut rates than in recent bouts of volatility. And then you kind of layer on the fact that after a pretty big run up, valuations were a bit stretched. So I think it's the cross current of all those things that kind of make it a little bit unique. But in general, the main theme is the market hates uncertainty. And we've got multiple vectors of uncertainty right now. And the market is really trying to digest it all at once, which makes for a bit of a choppy ride.
Yeah, I would say over history, we kind of see one thing play out that caused the drawdown, whether it's a government shutdown, earnings growth, COVID. We're getting hit in like all sorts of directions right now with like lots of headlines. And so I think that is probably the most unique point from my point of view is just there's a lot of headline risk right now, and headlines could change tomorrow. We could be up 3 or 4 or 7 or 8%, who knows? And it's the volatility clustering is why you don't want to make bad decisions as an investor. The best days group with the worst days, and all we know for sure right now is that volatility is high. So it's the importance of a financial advisor to help you stay the course throughout that volatility.
Yeah, like Will mentioned, the amount of volatility is spiking at record levels right now. You can point to the 24-hour news cycle that probably wasn't as common in history. I wake up every morning and I have 9 different Bloomberg notifications blowing up my phone to the point where my wife hates it. Now, that's one, snippet of it, but to Will's point, that's why you have to, get advice from people you trust and stay focused on your long-term objective, because this bout of volatility might be different from the different cross currents that are happening in the markets right now. But what we've seen over the long term is even though the annual drawdown on the equity markets is, like Will mentioned, an average of 14%, in 34 of the last 45 years, the markets ended up positive. So I know volatility stinks. It's very stressful, especially if you're in a different point in your life. But as long as you're consulting the people that you trust and you're still on the right pathway to your objective, that's what you got to keep in mind long term.
I'm nervous, as I think most investors are, about the markets potentially falling further. So what should we do, and how do we avoid making emotional decisions at times like these?
Yeah, that's a great question because we're professionals, but we're all real people. I mean, we have our own retirement assets. We have our own 529s for our kids. We have our own savings that we're concerned about personally. But I think the most important thing to remember is that market timing is really, really difficult. If you look historically in the 20-year period ending in 2024, if you had pulled your money on down periods and missed the 10 best days in the markets, your return would have only been about 6% as opposed to 10% if you left it in. And what we've studied and what we know via the facts is that 7 of the 10 best days ever occurred within 2 weeks of the worst 10 days. So it might feel comforting, it might feel like a security blanket to pull money out of the market, but it's really, really tough. And one metric that we watch a lot when we're allocating capital is just these overall gauges of market sentiment. There's a few very popular data feeds that we can track. And right now, the sentiment readings are as low as they've been in a few years. And what we do is, we try to think about the adage of be greedy when other people are fearful. At a minimum, don't overreact. And if you have cash on the sidelines, think about it in terms of value, not price. The price of something is different than the value. The price is what someone will buy or sell it at. The value is what you get from it over the long term. So again, just to emphasize the point, it's dangerous to try to market time. And if you try to get too cute with your investment strategy, you might miss a lot of the upside because the good days often follow the bad days.
Yeah, I would say stocks going on sale is the one thing people run from. Everything else goes on sale, you flock towards it to go buy as much as you can. So I think market volatility and drawdowns are really important to help you feel what your risk tolerance is. If the market's being down 10% or making you nervous and you're worried about future returns, you're not an aggressive investor. You should talk with your financial advisor about the right asset allocation on the more conservative side of things. We've probably got clients that are out there calling their advisor wanting to load up the Mag 7 right now just because they're aggressive investors and stocks are on sale, and so they're getting a discount. So it really just depends on your individual risk tolerance and how you view volatility with regards to how best we can work with our financial advisors to position your portfolio.
Yeah, I don't know if there's really anything I can add on top of you two. Those were pretty much perfect answers. I mean, just reiterating the point, if we could time the market, I don't think we'd be working here. We would just do it on our own and be perpetually wealthy and trade our own accounts every day, all day, and always be perfect. But that's not the case. Like we said, it's a long-term plan. And I know people don't like analogies all the time, but it's a marathon, it's not a sprint. So you always have to go back and reassess, like Will mentioned, what's your risk tolerance, what's your objective, and making sure you're relaying that plan to your advisor, whoever that may be, and making sure you're on the right pathway.
Yeah, and one other thing I'd add is that in our practice, we try to incorporate a lot of financial planning. It's often very comforting and it adds a lot of confidence when you can see, based on your strategic asset allocation, the mix of stocks and bonds overlaid with the long-term data, what you'll get from that. The next, weeks, months might feel volatile, but if you know within a high degree of certainty where you'll end up in 10, 15 years when you really need the money, when it matters, that's something that I always personally refer to when it feels like things are choppy.
Yeah, it helps to mitigate that emotion, right? Making decisions
Absolutely.
that are really based off of a plan, because we don't know when there's going to be volatility, but we do know that it will happen. So the plan can really help with removing the emotion from our decisions. That's great. That's a great point. If there's one thing to remember, it's this: volatility isn't the enemy. It's part of the game. The key is to stay focused on the long term, trust in a solid investment strategy, and avoid making emotional decisions in the heat of the moment. At Prime Capital Financial, we're keeping a close watch on the markets, making strategic adjustments where needed, and always prioritizing your financial goals. If you have questions, reach out to your advisor. If you don't have an advisor, contact us. We're here to help you navigate the noise and keep you on track. Don't forget to grab your free download, scan that QR code. That one-sheeter helps explain market volatility and how to plan for it. Thanks again to Clayton, Scott, and Will for their insights today, and to all of you for tuning in. To our audience, stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market. Until next time.